to learn more about our vision of the 2015 market outlook. And I know with this unseasonably warm weather, there are other temptations that might want to take you out of the office. So I thank you a lot for hunkering down and listening to this. I hope you get a lot out of it. First, let me start with a couple of housekeeping items. As you notice, the mute is on to keep the noise down, so please use your chat function if you would like to ask questions during the webinar. And then keep in mind that there will also be a few minutes for questions right at the end. And then, again, remember this will be recorded for those who weren't able to make it today. So let me introduce Patrick Morrell. As you know, most of you know him, but he's our investment guru and is responsible for putting together the investment analytics that you all see throughout the year. He doesn't get out of his little research cave very often, so I think he looks forward to these webinars. So let me introduce him, and he can let us know what we might expect throughout the 2015 market. Patrick, you want to take it away?
Thank you, Corby. I certainly appreciate the introduction, and I'd like to welcome everybody to our Capital Markets Review and Outlook. Today's February the 5th, 2015, as I have wrongly denoted on the presentation here. We're not going back to the future. But I am, as Corby indicated, very excited to be on the line with you all today. I apologize to anybody that's offended by my picture on the PowerPoint here, but I can tell you that I do enjoy this part of the business and really spending my time focusing on the economic landscape, how that relates to the investment markets, and then ultimately helping translate all of that down to you, our clients. So I do have about 10 or 12, I think, good topical slides that I'll walk through today. We'll start with the table of contents and just taking a look at the top news and events in 2014. I'll review really quickly some of the economic indicators that we look at here at Intermountain, but also that are viewed by others in the finance and economic world. We'll do a quick recap on the capital markets. We'll discuss commodities, and I think everyone's certainly been aware of the falling oil and gas prices that we've experienced here in the U.S. I'll quickly touch on what's going on overseas, and then provide a quick 2015 outlook, and then leave the line open for questions if there are any. So I'll without further ado, jump right into what happened last year. And this is tending to be a more and more widely used format for a slide as we're doing these presentations semi-annually and annually. What we've really experienced in the markets as a whole over the last few years has been this alarmist attitude toward headlines, meaning, market-related or non-market related notable news events are ultimately driving prices in the market, whether it be up or down. We had quite a few headlines last year that really caused some disruption, but ultimately, at the end of the day, certainly couldn't derail the markets from producing positive returns in 2014. If you look across some of these pictographs that we've put on the screen for you today, we certainly had some issues with the disappearance of the Malaysian airline back in March. But I would say some of the most impactful things that we experienced last year were really centered around the areas of commodities and oil prices. So we actually saw oil prices fall from about $115 a barrel all the way down to $50 a barrel, and it seems to be hovering around that price point even today. We saw for the first time in over a decade a very strong dollar relative to the euro. Over the long term, the dollar costs about, it costs about $1.35 $1.35 for every 1 euro. If you look over the last 20 years, that margin is actually compressed, and you're actually close to parity dollar for euro, although the euro tends to be just a little bit more expensive today than the dollar. And then on the geopolitical front, we certainly had a number of issues stemming from Russia and their overtaking of Crimea. We had some issues going on with ISIS, and certainly we saw the new Fed chief, Janet Yellen, sworn in here in the U.S. back in February. So all of that really roused the markets, if you will, for much of 2014. We saw some dips and some recoveries. But what this slide is really meant to show you is that if the markets are resilient and the economy is strong, then things we see on TV and the headlines that kind of come across and grab our attention seem to only be temporary nuisances to the market. And at the end of the day, fundamentals in a strong economy are really what are driving the returns both on the bond and equity side. If we look over at the economic indicators that we track here internally, it's worth noting a couple of things here on this screen. First, as it pertains to the Federal Reserve Bank and the drivers that cause them to take action in regard to the interest rate or any quantitative easing programs that they have introduced to the country, they're really looking at the bottom half of this screen. They're looking at consumer sentiment, they're looking at economic expansion, they're looking at unemployment, and they're looking at inflation. And if you look at the metrics that we have here on the screen today, they all seem to be fairly favorable, if not a little bit lower than what we'd like to see. In terms of inflation, the Federal Reserve is really looking for an inflation rate of about 2% to 2.5% in order to be in a kind of normal price expansion environment. We see inflation modestly lower at about 1.28%, which means that the cost of goods that you and I are buying day to day are only rising about 1.2% in price year over year. So the cost of milk, the cost of eggs, the cost of clothes is rising at a lower level today than it historically has been. Unemployment has continued to improve throughout the year. So if you think about where we were back in 2007, 2008, the peak unemployment rate after the recession was close to 10.5%. It's been a long, slow, arduous decline to bring that rate down from double digits, even high single digits, but we are now approaching more of a normalized unemployment environment, and the federal government actually calls what we're in right now full employment, meaning the unemployment rate's between 5% and 6%. Most employable people in the United States have jobs. So that is very favorable from an economic standpoint. We're also seeing continued growth and expansion through the GDP here in the U.S., gross domestic product. So the goods that we're producing and shipping overseas continue to expand. In the fourth quarter, it was at a rate of about 2.5% annualized, which is on par with what we've really experienced over the last 5 years. If we scoot forward, we can take a look at how these indicators have really impacted the capital markets. So between the headlines and a series of really favorable economic statistics being released throughout the course of 2014, the markets responded very favorably. If we look here at the lighter blue bar, we saw that in the fourth quarter, U.S. equities as a whole were up about 5.2%. For the entire year 2014, they were up about 12.6%. Very strong return if you look at what non-U.S. equities did, denoted by the gray bar. Foreign stocks faced with an immense amount of challenges actually lost money in the fourth quarter. They were down about 3.5%, and that closed the year down about 4%. Some of the issues facing some of those overseas countries primarily stem from what's going on in Europe, which I think everyone is fairly aware of, and some hiccups, or let's call it economic issues going on over in Japan, one of the other largest developed economies in the world. On the European side, we continue to see struggles with their own monetary policy. So if you think about some of the actions that we've taken here in the U.S. from the Federal Reserve Bank, we've employed a series of what our government calls quantitative easing steps to try to push more money into the economy, make money more readily available, make the cost of borrowing and lending cheaper, and ideally spur economic growth. The successes that we've had over here in regard to quantitative easing have not been experienced overseas in Europe. Because if you think about the European Union as a whole, you've got 18 separate countries with 18 separate economic landscapes, economic drivers, 18 different levels of unemployment and inflation and economic growth. And so it's very hard to find one common commensurate quantitative easing program that helps the entire union. So there's been some struggle over there in really finding the right solution, and I think the stock market has reflected that. In regard to U.S. bonds, bonds had a fairly stable fourth quarter, up about 1.8%. You'll see that denoted here in the orange. If you look at them as a whole over the past year, they returned 6%. So if you're one of the spectators on the sideline wondering when interest rates are going to rise and how that's going to affect or hurt bond prices, it certainly didn't last year. And the primary reason for that is the amount of volatility that we saw in the equity markets. We saw that stocks as a whole ended here in the U.S. up over 10%, but that didn't come easy, and it certainly didn't feel good getting to that 12.5% return. A lot of those economic headlines, a lot of those headlines that we saw on the first slide really created a lot of additional volatility in the stock market, meaning, there were days when the stock market moved up or down by 1% or 2% on a regular basis. If you think about the size of the stock market, a full percent or even 2% move on a daily basis is a lot of volatility. It's a lot of volume, a lot of trading going on in and out of different types of securities. It felt a little bit worse this year given the volatility because prior to 2014, we didn't have as much volatility in our markets. 2013, 2012, 2011, they all had their own nuances and their own challenges, but the market didn't trade, as emotionally as it did last year. And so, while we did see that good 12% return in stocks, there were many times when investors fled to bonds. And as investors flee to bonds for the perceived safety in those securities, it drives the prices up and ultimately produces a positive return. So, interest rates weren't much of a factor this year for bonds, but we certainly expect them to be a bigger factor in 2015. Just to round out, real assets, as we view them as real estate in this light gray bar and commodities in this kind of tannish gray bar. Real assets as a whole, performed moderately well, but it was really driven by the growth in real estate and less so by the fall in commodities. I mean, oil prices really took its toll on the stock market and definitely took its toll on the direct commodities themselves, including oil and gasoline products. If we flip forward and take a look at what worked and what didn't work last year, again, we saw a very positive return in both the stock and bond markets, but there were certainly some sectors within those two assets that didn't work so well. So if we look over on the side that worked, global REITs and U.S. large cap stocks were really the two best performing areas of growth in 2014. But you see that even infrastructure, emerging market debt, U.S. bonds, global equity, small cap stocks, all denoted here on the left-hand side of the chart, seem to perform fairly well and produce, even amidst the volatility, produce investors a positive return. If we look over on the right-hand side, it should be no surprise that commodities were one of the worst performing types of investments last year, given the fall in price. But even non-U.S. equities, emerging markets, and global high-yield bonds all suffered a little bit of a pullback in the year. I would say, on a whole, if you were a balanced investor and you had a little bit of everything, your portfolio did relatively well, 4.7% total return last year. It means that you've certainly captured some of the gains here on the what works side, but you let some of the what didn't works pull the portfolio value down just a little bit. If we flip to the next slide, we can actually take a look at some of the market leaders and over a couple of different time periods over the past 10 years. I like this slide a lot because it helps me at least visualize why we diversify our portfolios, both in our 401ks and even outside of our 401ks. Different segments of time, different periods in the investment markets will be favorable for some stocks and some types of investments, but certainly will not be favorable for all types of investments. If you look at the period from 2001 to 2006, U.S. stocks underperformed all of these assets listed, non-U.S. equities, emerging market equities, U.S. bonds, real estate, commodities. These 5 types of investments all outperformed U.S. stocks from the period 2001 to 2007. It was more of a drive toward emerging markets, emerging market growth, and real assets in the forms of real estate and commodities. But fast forward to 2008, after the collapse of the stock market and the recession that we climbed out of, stocks outperformed all of the assets, all 5 categories listed above, and that really denotes to the U.S. emerging from this recession that we came from, and investors willing to take a little bit more risk than they were previously. The point in this slide, again, is to show you that it's not worth trying to time or trying to guess the best asset to buy in any given year. The idea is that you should have a little bit of everything in your portfolio to make sure that you're growing with the way of the world. You've got exposure here in the U.S. to our growing stock market. You certainly have exposure to non-U.S. stocks to try to diversify some of that stock risk. Bonds, real estate, and commodities all have their own growth drivers. So there'll be times when stocks work and maybe these other assets don't, but as you can see here, the roles certainly do tend to reverse. So it makes a lot of sense to make sure you've got exposure to these different areas of the market. I'd like to spend a few minutes just talking about the falling oil prices that we experienced throughout 2014. I started driving automobiles in 1994, so that gives you a little bit of indication of my age. And price of gas at that point was about 89 cents a gallon, and that even seemed high for a struggling teenager in high school. We saw over the course of a summer my senior year in high school, gas prices went up to over $1, and everybody was throwing their arms up in hysterics. Well, fast forward to 2013, 2014, gas prices, off their highs were still relatively expensive, $3.50, $4 in certain areas of the country. What we saw in 2014 was this dramatic fall in oil prices, which translated into lower gas prices. The main driver, the main reason that oil prices fell so significantly was based on the amount of supply available in the world. So here in the U.S., we've done an immense amount of drilling and fracking, both for natural gas as well as crude oil resources. But that's been happening globally in areas like Russia and the Middle East, Saudi Arabia, Brazil, for decades. So our new discovery of all these additional natural resources here in the U.S. has really driven down our demand. We're not buying as much oil overseas, and we're not importing as much oil as we used to. We're using a lot of our own naturally produced oil here in the U.S., and so what that does is ultimately create a lack of demand for those global oil producers overseas. Typically, when there's a lack of demand, you'll see the oil producers, both in Saudi Arabia, Russia, and other parts of the Middle East, you'll see them start to wane or slow down their production. But that didn't happen this time. OPEC came out in June or July of this year and planted their flag and said, we're going to continue producing oil at the volume and levels that we're producing oil today. We're not going to let the falling prices reduce our production. So that even further depressed prices, because here we are with cheap oil with more coming to market. So the fall in oil prices, certainly is a net windfall for most people. It costs you less to fill up your car, costs you less to fill your homes, it costs manufacturers less oil to produce plastics and other oil enriched products. So it ends up typically being a tailwind for both businesses and the end consumer. While it tends to be a tailwind in terms of spending for those folks, it also weighs heavily on the stock market. If you look at the stock market as a percentage of oil companies, the S&P 500 index contains about 30% oil companies by market cap, meaning when oil prices fall and the stock price of Exxon and Chevron and Valero also fall, that drags down the equity markets. So we did see some hiccups in the stock market based on these falling oil prices, but as a whole, these cheaper prices should be a tailwind to our economy. They should assist us in the U.S. in growing economically throughout the course of this year. And even if there was a slower dramatic rise in oil prices, it typically wouldn't curb the economic growth that we're expected to experience this year. If we flip forward and take a look at the implications of cheap oil.
Pat, we have one question.
Sure.
Matt poses, what could we expect from the equity or bond markets if we see a rapid increase in oil prices this summer? And do you expect that that's possible?
Sure, that's a good question. As it relates to equities specifically, rising oil prices, especially rapidly rising oil prices, should positively impact the stock or equity markets given the amount of oil company exposure in those markets. Meaning rising oil prices is a windfall for companies like Exxon and Chevron and Valero. It's also a windfall for ocean drillers and explorers like Rig and Transocean. It's also good for oil refiners like Cushing. It's also good for master limited partnerships, which are really formulated to facilitate the transportation or the pipeline transportation of oil. So rising oil prices are going to have a net positive effect on equities in our view because it's going to ultimately bolster the financial statements of the companies distributing and mining for this oil. As it relates to the bond markets, it's really tough to say because there's not a high degree of correlation between oil prices and what's going on in the fixed income markets. Those are going to be in this year primarily driven by the interest rate calls by the Federal Reserve. So I wouldn't necessarily look to the bond markets when you're seeing the price of oil fluctuate. You're going to want to pay much more attention to the stock markets because I think it's going to have a more dramatic effect there. So as we look at the potential implications of cheap oil, I did talk about it being a tailwind for the U.S. economy. So the challenges that we see with oil prices the way they are is that, again, energy companies become less profitable, less financially strong, less able to grow and expand if the cost of their product has been cut in half. So that falls both on the high-yield bond side, smaller energy companies trying to grow their facilities. It also hurts energy companies in general, which, as I've stated, comprises about 30% of the S&P 500 index. So big exposure in the stock market. But when you look at opportunities of what cheap oil brings, again, it puts more money in your and my pocketbooks. So I have more money to go out to dinner, buy more clothes, and buy my girlfriend a manicure. Those are things that are ultimately a tailwind for you and I. Companies that often use a lot of oil or have high oil inputs will also be extremely profitable. American Airlines in the fourth quarter had one of their best quarters since 1999 because of the cost of their largest variable input, which is oil. So you'll see airlines, trucking companies, industrial companies like Caterpillar and Cummins, John Deere, those companies should all benefit from cheaper oil because their products will be much more attractive now that it doesn't cost as much to use them, simply put. So if we flip forward, I want to take a few minutes and just talk real quickly about the Federal Reserve, what Ms. Yellen has done under her first year at the Fed, and try to give you at least a little bit of an idea of what's going to happen to the bond market if there is an interest rate rise. So typically what happens when interest rates rise, and typically how the Fed starts to administer increases like this, are very coordinated and very communicated in advance. So if you look at how the Fed has kind of communicated with the open market over the past couple of years, they've got very specific terms and very specific language that they use when they're not only announcing the upcoming meetings and the meeting agendas, but when they talk through and describe the meeting minutes at the close of the meetings. They're trying to facilitate as much as they can their view on interest rates, their view on inflation, their view on unemployment rate, GDP growth, things like that. Because the idea is they want to give the market enough time to try to react to what's happening. So what they're trying to avoid is sitting down for a Fed meeting, raising interest rates 2 points and throwing everybody off guard. What they're trying to do is provide a coordinated action with the rest of the market to say, okay, we think based on the economic indicators that we follow, that the economy is in line for tightening monetary policy. What that means is they're going to raise interest rates. But they're not going to do it by 1% or 2% or 3%. What they're going to do is probably move them in quarter-point increments. So 0.25% this quarter. Next meeting, maybe 0.25%. Next meeting, maybe 0.25%. What they want to avoid is a dramatic increase in rates that will ultimately shock the bond market and drive bond prices down. So if you look at going back all the way to 1971, the interest rate at the first interest rate hike in 71 was 4.2%. The interest rates were moved up by a quarter point. It looks like stocks suffered marginally in the first 3 months, about 7.3%. Bonds were down a little bit as well. But if you look at the first year after that rate increase, stocks proved to turn positive that year, and more investors likely fled the bond market. And bonds even produced a higher return, given the higher interest rates, because it gave portfolio managers and investors an opportunity to sell out of the securities they were holding at that lower rate and buy into that new higher rate bond. So again, this coordinated action with the Fed is ultimately going to help money managers try to front run that rate increase, get rid of some of the stuff that they've got on the books that is going to go down, and look for some new issue bonds that have got that higher interest rate. So if you follow this chart all the way down from the 70s into the 80s on into the 90s, you'll see that if there is, again, that interest rate hike, the first 3 months are probably going to be the most painful. But if you look at how the rate hike affects the economy as a whole, we anticipate it to be really kind of agnostic by year end. We expect, even in a rising rate environment, that both stocks and bonds will continue to perform in line with expectations. So if we flip forward, with all that said, here's our crystal ball. And yet another reason to diversify. So this chart can be a little bit confusing for some folks, but each color square represents a different type of asset. So the gray squares represent emerging market stocks. The orange squares represent global real estate. The dark blue squares are global equity, light blue squares, U.S. equity. And we break it down by calendar year, just sorting how each of these assets performed year in and year out. And the only conclusion that I can gather from this chart is that I can't tell you what the best performing asset is going to be next year. I can't. Because year in and year out, each one of these assets has different drivers, whether it's supply and demand, whether it's cost, whether it's opportunity, whether it's lack of other choices. These assets tend to fluctuate year in and year out. If you look at how emerging markets performed in 2007, you wanted to have all your money invested there, 40.9% return. But had you put all your money in emerging market stocks and waited just one more year, you would have lost half of that. If you would have been able to hold on through all those losses and all that turmoil, emerging market stocks rose to the top the following year. It's tough to call tops and bottoms. It's tough to figure out a short-term market fluctuation versus a long-term negative trend or growth in a security. So if you look at a balanced portfolio, which is this grayish blue box in the middle, it pays to be balanced. It pays to own a little bit of everything. Because instead of your portfolio ending up on the top or bottom of this chart year in and year out, your portfolio ends up just about right in the middle, a mix of all the assets. There's only 2 calendar years over the past 10 in this chart where a balanced portfolio produced a negative return. The first was 2011, and the other one is 2008, where the stock market lost, close to 50%. I'm sorry, close to 40%. The balanced portfolio only lost about 27. So again, it makes a lot of sense to not just try to pick the assets you think are going to hit home runs in 2015. Pick a basket of different assets. Let them try to offset each other. Let them try to quell the losses of others, and hopefully, move your portfolio in a positive, direction. So forward, I can close real quickly with our view of the economic landscape over 2015. we've broken this up really into 3 different zones, which is the U.S., what's going on over in Europe, and then Asia. So in the U.S., as I indicated, we are one of the stronger economies in the world right now. Our forecast economic growth rate, denoted by this real GDP, is expected to be about 3% annualized throughout this year, and that'll be about 0.5% higher than it was last year annualized. We expect inflation to remain tame at about 2%. If you remember that economic indicator chart that I mentioned earlier in the presentation, inflation right now is about 1.28%. So a 2% core inflation rate is certainly attainable. As the unemployment rate falls, as the economy continues to strengthen, we're expecting employment gains of about 200,000 jobs a month. That is slightly above the average that we experienced in 2014, but adding jobs at about 200,000 jobs a month will continue to add at least 10 to 15 basis points to that real GDP growth number. And finally, we expect, at least here in the U.S., the Federal Reserve to start raising interest rates around mid-year. Their first meeting in January indicated their support of the markets and the flexibility they possess as regulators. But at the end of the day, as this economic data continues to improve, as our economic growth rate improves, as our unemployment rate improves, the Fed is going to be forced to make that first interest rate increase. So they've done what they could to project that out to the markets there in January, and as their next meeting approaches, we can probably look for some more specific language leading up to that meeting. We expect, given all that information regarding the U.S. economy, we expect probably mid to upper single-digit returns in the stock market. So the S&P 500 did about 33% in return in 2013. It performed a little over 12% in 2014. Now we're looking at more like an 8 to 9% return in 2015. It's not to say that stocks as a whole are losing steam, but but in general, prices have had such a favorable run up over the past few years that valuations and fundamental review of some of these names are becoming a little less attractive than they were a year ago. If we look at what's going on over in Europe, we certainly don't expect them to have as favorable an economic environment as we have here in the U.S. Their economic growth rate is projected to be anywhere between 1 to 1.5%, and the basis for that growth rate is really predicated on the need for a coordinated monetary policy and monetary support. So between the Federal Reserve and the different banks located in the 18 European Union countries, we're really looking for them to all come together, help countries like Greece and Spain and Italy continue to come out of the difficult economic situations that they're in. And if we do see some positive momentum going on over at Europe, we do expect that economic growth rate to improve and ultimately be reflected in the foreign stock market. As it relates to the markets over in Europe, valuations look attractive relative to the U.S. just given the pullback that we've seen in prices of foreign equities. Given that they dropped about 4 to 4.5% over the course of 2014, there is a little bit of valuation attraction there. But it's tough to say when's the best buying opportunity over in Europe, because we do think that over at least the first half of this year, their economic environment is going to be tumultuous, and it's going to be reflected in a volatile stock market. So my suggestion, at least on the Euro side, is if you're looking to gain exposure to international assets, I would look at strong fundamental companies, big multinational companies like we see here in the U.S., companies that have revenue exposure outside of just the Eurozone. We want companies like Bayer Aspirin that are selling aspirin all over the world, or Toyota that are selling Toyota cars all over the world. What we don't want to buy is a single security based in Europe that is solely supported by revenue from Europe. If we flip over to Asia, the caption kind of says it all, more of the same. It was funny, headlines came out kind of the very beginning of January discussing how China was in an economic slowdown. when in fact their GDP growth rate was about 7.5% in 2014. Believe it or not, that's one of the slowest growth rates China has experienced over the last decade. So when China's growth rate goes from double digits of 10 or 11% growth down to 7.5, this is their version of a recession, or their version of an economic slowdown. Their government is certainly in line and position to be extremely stimulatory. So you'll continue to see China build infrastructure, add roads, build factories, and so on. But we do expect their growth rate to be a little bit slower this year than other years. Japan is actually in a secondary kind of deflationary, recessionary period as they were a few years back. It looked like, based on their own monetary policies, that they were going to be able to quantitative ease themselves out of the situation that they're in today. But in fact, they continue to face a falling inflationary environment and not a whole lot of economic growth. And so we're seeing more and more Japanese monetary policy to help try to support their fragile economy. How does that affect the market and the investments over in those areas? Well, we should see a strengthening Japanese recovery as they continue to add these quantitative easing measures to their economy. We do typically like Asia-Pacific equities over other global equities, just given the amount of growth and opportunity in those areas. I can tell you that from a value standpoint, European equities look a little bit more attractive, but from a stability and strength and momentum standpoint, Asia-Pacific equities look a little bit better. So you have to really, you have to decide on your own, would you rather be more of a growth investor or more of a value investor in this case to be able to make that decision. But across the board, as you look at these economic outlooks, we are expecting continued global economic growth. No one area of the market is expected to really drag the rest of us down. And so as you think about how this affects your portfolio specifically, just remember to remain diversified, because we do want you to have exposure both here in the U.S. and overseas. We certainly want you to have exposure to both stocks, bonds, and real assets such as real estate and commodities. So there's a lot going on here, and I know a lot was said, so I'd actually like to pause here for a few minutes, and hopefully we've got some good questions, or there's some stuff I can help clarify for people. Please feel free to either raise your hand on the webinar meeting or type in your question to Brady and I, and we'll do our best to answer it for you.
I have one question here, Pat, about emerging markets. Looking back at that chart that showed all the different asset classes, and seeing the emerging markets have really not produced the way many economists expected them to, what's our expectation for emerging markets in the next 12 to 24 months? Is that a place that might deserve some overweight in the portfolio?
Yeah, that's a great question. Emerging markets are having a very tough time over the past couple of years, which is drastically different than what we've seen really over the past decade from the emerging market space. You have to remember that emerging markets are comprised of more growing countries like China and India and Brazil, but they also contain countries like Russia that's having a very serious economic spell right now. So emerging markets as a whole are probably going to continue to be extremely volatile in terms of price over the next 12 to 24 months. But if you're looking in specific areas of emerging markets like India, like China, and having more direct exposure to those areas and less exposure to Russia and Brazil, then you're probably expected to have a better experience in those kind of those Asia-Pacific securities than all emerging markets as a whole. Remember, Russia and Brazil their growth rates, their economic growth rates, are heavily dependent on the production and sale of oil. So as oil prices continue to fall, Russia and Brazil are probably going to be hit the hardest amongst all the emerging market nations. What it means for China and India is a tailwind, because they're the ones buying oil. They're the ones growing based on the consumption of oil. And so you got to be, I think you have to pick your areas on the emerging market side if you want to be invested there over the next 12 to 24 months. because it is going to be volatile, and a lot of that volatility is going to be based on oil prices, China, and Brazil. I'm sorry, oil prices, Russia, and Brazil.
Thanks, Pat. I actually don't have any more outstanding questions, so I'd like to thank everybody for attending. And we do have this webinar recorded, so if you'd like a copy of the slides or the full recording to share with any of your colleagues or employees, we'd be happy to provide that. We'll also post it to our website at some point here pretty soon. And again, thank you everyone for attending, and Patrick, thank you as always. Everyone have a great day.
Thanks, everybody. Have a great day.